Hello, my name's Kurt. I'm a value investor, and today I'm going to share with you 4 companies that I think are really good buys today. Make sure that they fit your personal goals. This isn't professional recommendation, but this is just stocks that I've evaluated recently. I love their value propositions, and I'm looking to add them to my portfolio. I'm also going to do an update of the $1 Million Challenge portfolio where we started with just $2,000. So let's talk about where we stand, what positions we hold, and at the end I'll share those 4 stocks with you that I really like at this point. And at the end I'll share those 4 stocks with you and what it will take for me to really enter positions there and add them to this portfolio. If this video provides you any benefit, any value, then a like is so appreciated, and subscribe so that you can follow along with my investing journey, my investing tips, and don't forget the most important thing, the ring, so you can stay tuned. So with that, let's dive in. Okay, so as you can see, the total balance in our portfolio was just under $10,000, which is really amazing considering the fact that just over a year ago, we started with only $2,000 and we've been adding in every 2 weeks, we've been adding in some capital. It's interesting though, we'll get into the details. We're actually in a negative profit loss position on this entire portfolio, which is really disappointing. But we're going to get to ways that we can remedy that and get a little bit caught back up. It might require a little extra capital than we planned for at the beginning, but it's going to be valuable to stay on track with that $1 Million Challenge rate. So let's talk about some market trends that are impacting everything that's happening. When we talk about investing and trying to get really high returns, these things are all happening at the same time. So depending on what part of the market cycles we are, we could be under target or above target. So let's talk about it. The Federal Reserve has kept interest rates high. I mean, moderately high. They're still not high enough to really deal with the inflation problem totally yet. And that you can take that how you will. But something they did that I did not think the Federal Reserve would be able to do was to get the balance sheet under $8 trillion by persistent quantitative tightening. That is really important, and it's starting to show up in the economy. The economy is starting to slow a lot in many different ways. We'll talk about it. But that should be softening stock valuation. So how long can stocks stay highly valuated relative to earnings, especially? Now, because people believe that the Federal Reserve might cut rates soon into the future, that's why valuations have been going up. But I think the interest rates are going to stay higher for longer. That's what the Federal Reserve keeps signaling. However, who knows? If we have some sort of crisis, they dealt with the banking crisis pretty well. But what happens if there's another employment crisis or something like that? The Federal Reserve might have to slash rates. And even though my projection is for the Federal Reserve to keep rates higher for longer, like they did back in the 1970s and 80s, that could be totally wrong. And the market is sort of betting that the Federal Reserve is not going to be that aggressive this time around. Mortgage rates, long-term treasury rates have been spiking. They've come back down in the last couple weeks, but that cost of borrowing is really weighing down on the housing market, on the employment market, just on business in general on Main Street. So we're going to see how that's going to continue to play out. Time is the factor now. How long can the economy continue to take these slugs and stay up? Meanwhile, employment is still okay. Unemployment is still relatively low, but it's starting to go up. It's a consistent troughing trend that we've seen in the last few months. Unemployment has slowly started to creep up after sharp decline after the COVID period. So workforce participation still lower than pre-pandemic, which is going to weigh on the deficits, which is going to continue to make prices continue to go up. Because if you have more of the workforce consuming but not contributing and working towards that production, then prices just have to go up to balance that out. Where's the money coming from? Well, it's coming from depleting savings right now. So we'll see when that's going to end and what's going to happen. But earnings around the board have been relatively lower in 2023 than they were in 2021 and 2022. That was to be expected, but across the board, the earnings have not supported the increase in valuation that we've seen. We've seen the stock market be resilient, going up, and it's really baked into those top companies, the Magnificent Seven, so to speak. There are still opportunities out there. Even when most of the market is overpriced, overvalued, you're still going to find deals, and that's what we're looking for, and that's what we're going to buy. Now, here are the positions in the portfolio. We have 8 current positions. We have Nexstar Media and Medifast up at the top of the pack there. They're each over $2,000 on cost basis. It starts to drop a little bit after that. Ally Financial number number 3. And then Gray Television, I've increased my position a bit there. That's sort of a new position since the last time I did the update, I believe. Vista Outdoor, I've trimmed the position a little bit. CHGG is a new position. Flexible Solutions has really given me a lot of problems recently. And Connect One Bank has recovered decently since the last time when I did the update, when there were some problems in the banking sector. It's recovered. It's still not at fair value, I don't believe, but those are the last 2 positions down there on my portfolio. The net value in the market is, like I said, $9,900, including that $145 we have in cash there. But the net fundamental value is actually almost $37,000. The net fundamental value is what I calculate to be the intrinsic fair value at a good rate of return for each of the companies summed up. So if all of the companies were to restore to their intrinsic fair value, I believe that the portfolio would be at $37,000. That's almost, I think, almost four times what it's worth in the market today. So we're sitting on a lot of potential energy building up in the valuations. Now, how long is it going to take for some of these positions to realize their fair value in the market? May take a long time. At the very beginning of this challenge, I said we need to hold these companies for 2, 3, 4 years until some of them realize their fair value. But if they do, that's 4 times value in the span of 4 years. I'll take that. That's 100% per year. The realized profit and loss from all the positions we've sold that we originally bought is over $1,100, but right now we're at an unrealized loss of $1,200. So it's not going particularly well to schedule, but we're in a rough patch in the market, so it makes sense. We're going to have to survive this rough patch to see those really great returns in the future. I want to put this slide up to show that the value to price ratio for each stock is, all these companies are over 1.5. So 50% higher or more. Like CHGG is at the bottom there. It's 50% more valuable than the price it's trading at, according to my valuations. But those 2 companies at the very top, Ally Financial and Nexstar Media, are companies that we want to put a lot of our capital toward. Medifast is also up there, and Vista Outdoor is also up there, although Vista Outdoor has had some earnings issues recently. So I really think that Nexstar Media is a powerful compounding company. Ally Financial is a huge online bank. They're going to have deposit growth. They're going to have earnings growth. And right now, the financial sector is a little bit depressed. But when things return to normal, I think owning Ally Financial will pay off huge. So those are companies that we want to really invest in. And those at the bottom, we might consider selling out of the FSI, the CHGG, the Connect One positions if we see a good opportunity to sell out of them and rotate into other companies that are really highly valued, which I'll talk about in a second. To cap up the portfolio performance compared to the S&P, we have not had good success recently, but you can see in the last 2-week period, we are in the positive finally, and hopefully that will continue towards the end of the year. We're really counting on that Santa Claus rally. We are at a negative differential to the S&P since the inception of the fund, of the portfolio of negative 11. But again, we're hoping that can turn around. We have huge unrealized gains in Nexstar Media and a couple other positions. So all it is a matter of time at this point. This is the schedule. Where we're supposed to be is the dark blue line. You can see that is 36% higher than where we are today after some lackluster returns performance. And so there's a couple ways we can get back on track. I'm thinking about including a one-time deposit of like $1,000 or $1,500 to revamp and juice up this balance that we have to get a little bit closer. But we really need to increase our performance, obviously, but we think that will happen. But I'm also considering increasing the contributions up to something like $350 every 2 weeks to catch up. So with that, let's talk about some companies that we really think could be additions to our portfolio that can get us moving in the right direction. These are the 4 companies that I think are good companies to buy in November of 2023. An interesting note is that I've evaluated now at this point 282 companies just in the last 2 years. And I'm really shooting for 300 evaluated companies by the end of the year. If I do my homework and get into it, we can get there. That will be huge. So we're making progress. Good things are happening. Now here are the 4 companies: Alibaba, Ethan Allen, Capital One Finance, and this agro company in South America that operates in Argentina, Brazil, and Uruguay, I believe. So starting off with Alibaba, Alibaba has a 3.7 value to price ratio. I think that this company is drastically undervalued. We know there's a lot of tensions between USA and China. And if anything were to happen, the big geopolitical risk is delisting or forced liquidation of Chinese assets, Chinese companies for US investors. But that notwithstanding, and we just did have in the last week a meeting between President Biden and President Xi of China in the US. So that was a really big development. I think that there's a big question mark there. I mean, I can't say what the right decision is, but when you have when you have such a consistent and big company like Alibaba with implied annual returns of about 30%, or just over 30%, that is something we have to consider. I mean, there's going to be options, there's going to be ways that you can own this company, and yes, there's geopolitical risk, but the Chinese economy is always going to be growing at this point. And that company is going to be growing its free cash flow. And just to talk about its free cash flow, here's what their free cash flow has looked like. It's that bar chart in the middle. That's their free cash flow per share. And you can see their price history on the top of the graph and their price to free cash flow ratio on the bottom. And you can see how low their price to free cash flow ratio has gotten. It's gotten below 10. It's gotten below 7 at this point. And look at the historic average. It's used to sitting around 20 to 30 because this is a growing company. And you can see, yeah, it went through a recession there from 2021, 2022, but it's coming out of that recession. The free cash flow per share is growing again, and the stock price has only fallen. It hasn't recovered. I think that's a great opportunity, even in the short term, really, for this price to springboard back up if stock investors get wind of any developments like, okay, China is less of a concern now than we really thought. The next company is Ethan Allen Interiors. You've probably heard of the company before, but you probably didn't know that their stock is trading at about 1.7 of that value over price ratio. So we have a big opportunity here. It's not the greatest. Now, I will say that Ethan Allen is a higher recession impact than most companies. But that being said, if we look at their free cash flow per share history, you can see, yeah, I mean, look, they spiked up after COVID with the easy monetary policy. They came back down, but they're going back up. Now, I think that this is something where people are spending more times in their homes. They're going to the office less. If you're working from home, you want your home to be nice. You want it to have nice furniture. And I think that's what they're benefiting from. But that's a longer term trend that I think is going to benefit the company. Right now, they're trading at a price to free cash flow ratio of about 7.2. That's a really good ratio. Their price is elevated at this point, but they could still be justified. So look at the balance sheet. There's a couple other things we need to check. I'm not ready to invest right now today, but if the price comes down a bit and that price to free cash flow ratio gets even better, and look at the historic average, it's around 10, and right now it's below that 8 level. It's in the 7s. So that could be something that, especially if the price comes down, I could really look at and bite on. Capital One Finance is that credit card company. They do lending, banking, finance, consumer finance, and I think that's also very risky because people could be defaulting on credit card debt. But I think even if you adjust for all those risks and you decrease their assets, increase their liabilities, look at their free cash flow, reduce it, put on as many safety factors as you can. I've done that in the valuation, and it's still at that 3.6 value to price ratio with implied annual return of 30% for a huge brand, Capital One Finance. They're always going to have those customers. So I think that's something that we have to look at. This is their free cash flow in the middle. The price to free cash flow ratio is down to 2.5. 2.5 price to free cash flow ratio. And their price has come down. Remember, it was at $150 per share. They're down. They were below $100 per share, and they're just above $100 per share. I think that this company, yes, their free cash flow is going to slow down. It might come down a bit. But when we see the price really drop, I think that could be a really good opportunity. And even right now, why not bite on this? I mean, yeah, there are huge risks in this space, but you've always got to look for huge deals like this when you see 2.5, 2.6 price to free cash flow ratio, especially when the historic trend is closer to above 3, closer to 4, even 5. It gets up to a 5 price to free cash flow ratio. So Capital One Finance. The last one is an agricultural company. They have farmland and they have farm products that they sell in South America. Now, if you've been with me for a while, you know that I really had a big position in LND, Brazil Agro. This company also operates in Brazil and Argentina. They have that 1.7 value to price ratio. It's a steady industry, and I would buy this company. They're sitting right there at $10 per share right now. I would buy if they get much lower than this point right now. Yes, they've springboarded their price. It's very high recently, but look at that consistent free cash flow. You can see they used to be negative. They've gone into the positive. It was fluctuant, and we're starting to see bigger and bigger blocks there in the free cash flow per share. Right now, they're at a 7.8 price to free cash flow ratio. It's right on that point where it's like, yeah, that's a great company to own. I'd love to see the price come down a little bit more, maybe $8 per share, maybe less than $8 per share. If it gets to that point, I'm a buyer of this company if the underlying trends have not meaningfully changed. So those are the 4 companies I wanted to share: Alibaba, Ethan Allen, Capital One, and Agro. Watch for me to add any of these 4 companies to the portfolio. And stay tuned for next time I do an update. We're trying to get this portfolio up, eventually to $1 million over the span of many years. So if this excites you, if value investing and learning about value investing excites you, and you want to keep seeing stocks like this that are good valuations that I've analyzed, make sure you are subscribed. I really appreciate the support, and comment down below if you know of any great companies that are at good values right now that you want to see me do a stock valuation video of. With that, best of luck investing, and I'll see you in the next video. Take care.